Welcome to The Explainer. Today, we are attempting something, well, honestly, kind of ambitious. We are putting one of the world's most debated bank stocks through the absolute ultimate investing gauntlet. As expert analysts, we're going to use a rigorous sequence of legendary analytical frameworks to completely tear down Citigroup's first quarter 2026 financial data. Here is the million-dollar question we want to answer today. With the actual titans of finance, I'm talking Warren Buffett, Peter Lynch, and Benjamin Graham, look at Citigroup right now, trading around $126 a share, and consider it a buy. Or would they just pass? We're going to apply their exact philosophies alongside modern discounted cash flow models to uncover the true intrinsic value of this banking giant.
All right, here is our roadmap for the gauntlet. We'll start with a quick Q1 2026 snapshot, then we'll push the stock through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll run some modern DCF and alternative models before wrapping it all up with our final verdict and synthesis.
Okay, let's dive right into Section 1, Citigroup Q1 2026 Snapshot. Let's set our baseline.
Before we start crunching formulas, we really need to understand what Citigroup actually is right now. This is a massive entity sitting on roughly $2.7 trillion in total assets. But more importantly, under CEO Jane Fraser, Citi has been going through this huge, multi-year structural revamp. And according to the latest Q1 2026 report, that transformation is now 90% complete at its target state. They're shedding legacy franchises, cutting out stranded costs, and simplifying their operations to fundamentally boost efficiency. So let's look at the raw materials we'll be using. Currently priced around $126 a share, Citi just delivered its best quarterly revenue in a decade at $24.63 billion. That is a 14% jump year over year. Net income surged 42% to $5.8 billion. That translates to a really impressive diluted Q1 earnings per share of $3.06, which brings the trailing 12-month EPS to $8.44. The return on tangible common equity, which is a huge profitability metric for banks, jumped to 13.1%. The book value sits at $112.22, and it's trading at a price-to-earnings ratio of 15.2x. Keep these numbers in your back pocket. They're the fuel for our gauntlet.
Moving into Section 2, the Warren Buffett lens. Time to look for those economic moats and consistent earnings.
When we evaluate a bank's moat, we have to look closely at their core operations. For Citi, that moat is unquestionably its Treasury and Trade Solutions division. They are literally the #1 ranked global cash management franchise, handling the daily operations for massive multinational corporations. That's a huge competitive advantage. Now, on the flip side, Buffett really dislikes complex operations and unmanageable debt, and Citi has historically been super complex. But remember, for banks, we don't look at standard debt, we look at capital ratios. Citi's Common Equity Tier 1, or CET1 ratio, stands at a fortress-like 12.7%. That essentially means they have a massive safety cushion of capital, well above the 11.6% regulatory requirement. So their financial foundation is actually rock solid.
Let's run through the rest of Buffett's qualitative checklist. Return on equity jumped to 11.5%, up from 8.0% just a year ago. Earnings are highly consistent, marking their best Q1 revenue in 10 years. When it comes to management treating shareholders right, well, they returned $7.4 billion in Q1 alone, mostly through buybacks. And finally, because standard free cash flow is famously tricky to calculate for banks, we use net income available to common shareholders as our proxy for owner earnings. That's sitting at a very healthy $5.48 billion for the quarter. So from a qualitative standpoint, Citigroup honestly survives the Buffett's lens with flying colors.
All right, on to Section 3, the Peter Lynch lens. Let's talk company categories and growth at a reasonable price. Under Lynch's framework, you always have to categorize the stock first, right? Citigroup falls squarely into two distinct categories. It's a classic turnaround and an asset play. It's a turnaround because of that multi-year structural simplification we discussed earlier, designed to eliminate those stranded costs. And we're seeing that work, with their efficiency ratio dropping to 58.1%. It's also an asset play because its massive balance sheet and historical return targets have often traded at a steep discount to its peers.
But the absolute crucial point for Peter Lynch is the PEG ratio, price to earnings divided by the earnings growth rate. Let's do the math here. We take Citi's PE of 15.2x and divide it by their trailing 12-month EPS growth rate, which clocks in at an impressive 21.2%. That gives us a PEG ratio of 0.72. Now, in Peter Lynch's book, anything under a 1.0 is considered a fundamentally undervalued buy. The growth profile here absolutely justifies the current price tag.
Section 4. The Benjamin Graham Lens. We're stepping into the cold, hard, pessimistic numbers game of the father of value investing.
We can run Citi straight through Graham's famous defensive investor checklist. Adequate size? Yeah, they have $2.7 trillion in assets. Check. Strong financial condition? That 12.7% CET1 ratio and massive liquidity buffers definitely cover it. Check. Earning stability? They just posted an 18.7% net profit margin. Check. Dividend record? They're actively paying out 60 cents per quarter, and they just raised it. Check. Moderate valuations? With a PE of 15.2x and trading at just 1.1x its book value of $112, it absolutely checks out. Citi systematically clears every single hurdle here.
But Graham also has a very specific formula for intrinsic value. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Let's plug in the Q1 data. We take the square root of 22.5 multiplied by the trailing EPS of $8.44 and multiply by the book value of $112.22. The math outputs an intrinsic value of exactly $146 per share. With the stock currently trading around $126, Graham's notoriously strict formula, which, let's be real, rarely gives a passing grade, indicates a solid 15% margin of safety.
Section 5. DCF and Alternative Models. Let's step out of the past and run some modern quantitative analysis. Let's see how modern models price Citigroup. A DCF model from Simply Wall Street, which assumes cash flows tied to an 8.8% earnings growth rate, outputs a fair value of $184.43. Meanwhile, the ticker mid-case model assumes a really modest 4% annual revenue growth, but models net margins expanding toward 21% by 2030, which totally aligns with management's efficiency targets. That model gives us a fair value of $167.91. Plus, a reverse DCF tells us that the current $126 price implies only low single-digit growth moving forward. But given the 21.2% EPS growth we just saw, the market is pricing in a highly pessimistic scenario right now.
And this is backed up by Wall Street analysts too. Looking at the consensus, the mean target sits at $144, with high estimates reaching $162. Almost universally, these models suggest a pretty notable gap between the current trading price and the intrinsic value of the business.
Section 6. Final Verdict and Synthesis. We've run the gauntlet. Now let's bring all these distinct philosophies together.
What's incredible here is the consensus across completely different schools of thought. Benjamin Graham's conservative, historical, asset-based formula says the stock should be $146. The ticker 2030 projection says $168. The Simply Wall Street cash flow model says $184. Whether you're looking backward at the book value or forward at the cash flows, every single framework dictates that a price of $126 offers a margin of safety ranging from 15% all the way to 46%.
But look, to be an expert analyst, you must weigh the risks against the strengths. The strengths are huge right now. Citigroup just authorized a massive $30 billion multi-year buyback program. That's going to systematically compress the share count and artificially drive up EPS, even if revenue stays totally flat. Their efficiency is rapidly improving, and return on tangible equity is hitting targets. Yet, we have to acknowledge the risks. Macroeconomic uncertainties and global conflicts could absolutely pressure the loan book, and non-performing loans did rise slightly year over year. Plus, strict value investors might note that its 15.2x PE is technically a premium compared to the broader U.S. banking industry's average of 11.9x.
So, combining Buffett's love for their cash management moat, Lynch's turnaround PEG ratio, Graham's strict margin of safety, and the massive DCF upside, the data strongly points to Citigroup being undervalued at $126. The structural transformation is undeniably working, but at the end of the day, investing is deeply personal. Based on this gauntlet and the margins of safety we've uncovered today, at what price does Citigroup become an undeniable buy for your portfolio? Think about your own risk tolerance and let these numbers be your guide. Thanks for joining me on this explainer, and keep learning.